Hello YouTube, welcome back to another video. Today we're going to be talking about another important topic on a beginner's journey on selling options, and that is ROI, or return on investment. Surely you've heard of the term before. Certainly the term ROI is used in a lot of capacities. Selling anything, typically you're thinking about a return on investment, or return on invested capital, ROIC, or return on deployed capital, which in the case of like selling cash secured puts, this is just another way to think about how you're using your money effectively. Because I think the reason we're all here is to make money, last I checked. So we do want to make sure we're making the most that we could be making whenever it is we're risking our own money in particular, since that money should matter to you more than any other money that you deal with. So today we're going to be talking about ROI, how we come up with it, how we use it to help pick the different trades that we're selling, and some different ways to think about it, maybe with some real examples that we'll get into here in just a minute. I did want to start with a green screen for the first time ever, not behind me, but like on the screen in terms of the stocks heat map. It's been a while since we've seen much green, so this is kind of nice to start the day with. It is the beginning of March. We just wrapped up February, which had a lot of red days. But it looks like we might be starting with a better trend than we did in February. So, although I guess February started with a good trend, but now we're seeing the opposite. So anyway, back to ROI. We're going to get started here with a little a calculator that I made that uses a calendar to help come up with the different multiples of percent return. And ROI is real simple. If you just say, hey, I spent $100, I made $10 selling something for 110, that's a 10% return, right? Wrong. Well, not wrong, but not really what we care about either. Really what we care about is the annualized percent return. And the reason we care about that is we need a way to commonize the metric. And if we just do ROI and it's like that $10, it doesn't mean that much, because $10 on $100 could be great if you made it in 5 minutes. It could be terrible if it took you all year. Or I guess actually that's still not terrible. It's still better than the average historical rate of return for the S&P. But maybe we use $1 as an example. $1 is only 1% return over the course of a year. But if you made that in a day, annualized, that's actually a pretty solid return. It's 250%, or whatever number you're using to choose what your APR is. So that's what we're going to start with, actually, is what are we using to determine our APR? And to do that, I've got a little calculator that I made in Google Sheets. You can click the link below to get a copy of that. And it's nothing fancy. I'm not suggesting it's groundbreaking technology here, but it's a nice little tool to use to see how things shake out when you're looking at various trades. So the way this works is we've got over here a date, which you can't really see. I guess I can move this. There you go. We've got a little date over here that is today. And if I were to show you the formula, you would see, in fact, it is today. Cool. And over on the left of that, you've got the various dates of the year and how many days to expiration until that date, and then a little multiplier for how we come up with what our annualized percent return is. So what day or how many days do you pick in order to annualize? How many days are there in a year? Well, there's 365 days in a year. But how many days are there in a trading year? And the answer is it depends. It's not always the same. This year it's 252, but President Carter unfortunately passed away at like 120 years old, and so the market closed one day. So actually, is it 251? Well, the average trading days per year is 251.8 or something. You can Google it, right? I like to pick 240. And the reason I pick 240 is I like to pretend I'm going to go on vacation at some point. Although realistically, you can go on vacation and still check your phone and do stuff. But still, I like to use 240, which is more of like a corporate number that you would use if you were working at a company. it doesn't really matter. All that matters is that you're consistent in whatever it is you pick for all of time. So for me, it's 240. For you, it could be 250. It doesn't matter. It's a commonizing metric to make sure that you're talking apples to apples when you're looking at how much money did my money make. And if we go back to the calculator over here, we can look at some live examples, right? So one of the examples that I like to look at is Clove. And the reason I'm looking at Clove is I'm not suggesting you should or shouldn't buy it. This is, as you can see over there, not financial advice, but financial education. And so don't sue me, please. Clove was actually just went through some earnings, and they were at like $4.50 a share. And personally, I had wanted to buy it like if it had dropped below $4. So I said, a great way to do this is to sell options on it. So I decided to sell some contracts. I think I actually sold, I don't know, like 20 or more, something like that. It wasn't a very expensive option contract. And at the time, I think this option cost was actually something like 35 cents. So it had a really crazy APR, but we'll get to that in a second. This is live percentages of returns if you were to look at the option chain right now, today, at the time of making this video. So we start looking out at what the option chain is. So that in the case of Clove, they have weeklies. Not all options have weeklies. Some only have monthlies. Some have 0 DTEs, right? If you're looking at SPY or something like that. So you need to figure out what is your play going to be when it comes to deploying your money. So what option do you want to buy? And the thing is, as you go through the month, right, you will see a different number of value assigned to each of those metrics or each of those options. And the option cost early on will have the lowest dollar value, but very often it has the highest return if you were to annualize it. So the way this works is $17 on a $4 stock, or 17 cents on a $4 stock, or if you do the math on the contract, $17 on a $400 contract, because it's lots of 100 shares, is going to give you a percent return, absolute return of 3.8%. And you can check the math, right? It's all over there in the formula bar, and you can check it if you want to click on it later, feel free. But that's in a 5-day period. It's Monday, right? So we're 5 days to expiration. So if you were to look at the APR, the annualized rate, it's actually 225% return on your money. All of a sudden, that weekly option sounds a whole lot better, right? Another interesting thing that happens here is sometimes the option value goes up and down over the course of time. And we see that in this example, and actually all of my examples, because we have differing amounts of volume and liquidity in these different option expirations. So most common expiration for people to buy and sell on is either this immediate week or the third Friday of every month. And that's because most options originally came out with the third Friday of every month being the option. That's when things expired. Over time, they've added more. As there's more interest, they add more dates. And so you'll see not all options have the same number of date options. It's just how it works. NVIDIA is going to have weeklies, and it's going to have dailies potentially, whereas some small stocks like, I don't know, I can't think of it off the top of my head, maybe Lucid or RXRX or something in the like less than $1 billion market cap, after you go out a few weeks, might only have monthly options. It's just, that's how they work out. In the case of Clove, we can see that things drop dramatically after that Friday that we were talking about, that third Friday of March, to hardly anything. And that's because these options probably aren't real. You could probably sell it for that, but nobody's buying them. So if you were to try to sell it at what it should be, which if you just look at 17, 22, 28, maybe this should be 30 and maybe this should be 32. Well, there's just no interest because there's no volume there. So people are looking at primarily this one here, which we'll highlight as a good day, right? And this particular week here, this first one, which is this Friday coming up. So these are the most common ones that people will check at. Okay, now there's a second part to this that we've got to keep in mind, which is not all options are held to expiration. So when you're planning your option trade, what are you planning on doing? Are you planning on holding it until expiration? If it's a weekly, the answer is probably yes with that 225, because in order to make more money, you'd have to sell that in less than 3 days' time at 50% or better profit. And that's important. So I've added a line here called 50% baby. It is when you would want to potentially buy back an option. A very standard in the industry being, I don't know, Reddit, I guess. If you're selling an option, it's very likely that you would be interested in buying it back for more than 50% if less than 50% of the time has already expired. And we can see that if we change this number here. So I added a little number here, which is date to expiration adjuster. All right, I don't have any fancy title on it, but that's what it means. And if I were to change this to 5, we have an interesting result. It shows that if we were to buy an option back at 50% in 5 days, where does it start paying? And the answer is, unsurprisingly, when it's less than 50% of the time expired of the option that we're looking at. So in this case, if you were to buy an option on the 5th day, on Friday at 50%, well, that's just dumb. You should let it expire and get the full 225% APR. If you were to sell it at 50%, you'd only make 90% APR because you waited that whole time, but you didn't get the whole time value of that money. Whereas if you did that on an option that was expiring next Friday, you would make a little bit more money because technically you're slightly more than 50% of the way there in terms of days to expiration. Another thing that I should mention is some people like to do this from a every day of the week standpoint, like 7 days. I do it as business days because those are the only days that I actually work. So in my mind, it makes more sense to do it on a business day perspective. Again, totally up to you. Doesn't really matter. It'll change the numbers, but they'll be relative to each other slightly differently. Back to what I was saying, in the case of buying back this beautiful 321 option, okay, I may not make as much money in premium, but I can still make a really solid return on my investment. Now, there is one other thing to consider that I do not currently. Oh, I'm sorry. I did include that. I think I adjusted it. Yeah, I did. This also takes into account the number of contracts that you've got and nets out the number of contracts in terms of your APR. So what that means is if you were to buy or sell an option, more specifically, since that's what we're doing on your brokerage, a lot of brokerages charge for the transaction. Not all of them, but depending on who you're working through, if it's Vanguard, you might be paying $1 a contract. If it's Fidelity, I think it's also $1. At some point, it might have been 65 cents or something like that. I don't know. Check what you've got, but you should net that out to get a true view of what your ROI is, because those dollar values that you pay do eat into your ROI. And you do need to consider that because it's going to have a bigger impact on lower priced options as a percent versus a expensive option like Reddit, or expensive stock like Reddit or Nvidia, something that costs over $100 versus Clove being a $4 strike. So anyway, if we go back to this, we can see that the returns get better and better if we buy them back at 50%. And if you go way out to mid-April, which this isn't even the best date because we'd want to look at the third Friday in April, we start getting pretty close to this weekly, which is interesting, very interesting. Some people like selling weeklies because this number is way higher and you just let it go to expiration every time. Some people like selling the further outdated options because they have an effect where they might swing more in price depending on how much the underlying share price changes. And that's one of the Greeks called Vega, which you can look into, kind of like the Street Fighter guy, which was a lot of fun to play. But a little bit different than the Street Fighter Vega. This one moves up and down based on how much the share price does. And it can be calculated, as all the Greeks can be. And you can look that up on various online tools to get a feel for which stocks have better Vega than others. I can tell you from experience that Reddit tends to have pretty good Vega. So while the 50% buyback returns may not look as attractive as what we see here for Clove, these can happen in like 2 days. There's been many times where I've bought Reddit back. This is the covered call side, by the way, for 50% in literally a day or less. And if you get to a day, right, and you look at this, all of a sudden you start going like, wow, okay, that's a pretty solid return for 1 day of capital deployment, and it's based on the stock's volatility, right? So there's a lot of moving pieces here that you've got to consider. What is the equity? What is the strike price, right? Is it a high strike price or a low strike price? What is the historical implied volatility of the stock? Is it moving a lot or not? What is the Vega of the stock? That's worth looking into as well. So if it moves by $1, if the underlying moves by $1, how much does the option price move by? Because that can generate quick premium for you in one direction or the other, of course. So a couple others that I like to look at right now as an example is Hood. Hood's a fun stock that I like to mess around with. Currently trading at $50. So I might consider selling options at $50, which is very aggressive. And the stock has recently been in the 40s. But if you're bullish on a stock and you think that the stock price is going to go up, but there's a chance that you get assigned at $49 or whatever, well, you might want to take that bet. In the case of Hood, I'd probably be looking at the 321 here, or the weekly. Actually, the weekly looks really solid for Hood. Typically, it hasn't been this high, but right now, it's also very volatile. What happened was Hood went through earnings pretty recently, and we can go back and take a quick look here at my charts, and we could just bring up Hood. And when I look at Hood and we look at the last month, we peaked at $65 a share, and now we're down to, we were as low as 45. And the question is, are we settling at this 50 range yet? Well, the fact is, there's a lot of uncertainty in that stock price right now. And because of that, the option prices they're a mathematical equation of the statistical probability of whether or not the stock is going to move up or down. We don't know, and by how much. So clearly there's a lot of volatility here. The market doesn't know if it's going to move dramatically up or down in a week, but it's highly likely it will move more than the cost of this contract, which, if we go back to my spreadsheet, was $1.87. And I looked that up this morning, which is from Friday. It's not an updated price. That'll probably change as soon as the market opens here in like 5 minutes. But until that happens, this is our example. So that's what we're going with. So $1.87 on a $5,000 investment, or $50 a share times 100, is going to give us a pretty solid return. That might be something that I go, oh, okay, well, that APR, if you sold that every week and made 200% every week, you'd probably be pretty happy, right? But the risk of that is, because of the volatility, that stock could drop by that much, and then drop by that much again, and then drop by that much again. If we go back to the chart here for a second, you can see that if you did this at 65, you'd be pretty sad right now, because you would have lost $20 in value per share from 65 to 45. So it's not free money, right? And conceptually, when you're selling a CSP, if you want assignment, yeah, you basically want it to be bouncing around in that area. But if you're really just doing it to generate premium and don't mind assignment, which is, in my case, what I'd be doing with this particular contract, well, you generally want it to go up. If you get assigned, cool, but hopefully it doesn't drop to 25, right? Because that'd be painful. Then you're looking at you're still paying $50 a share minus $1.87 per stock price, per share, right? So that'd be painful. You don't want to do that. But we can't time the top or the bottom. That's not a thing. So we pick our position, we pick our point, and it has the best chance of making us some money, or well, it's guaranteed to make us that premium anyway, and we feel confident that will net out okay. So that might be a stock that you're interested in pursuing, or that I'm interested in pursuing. You gotta, like I said, not financial advice. You gotta decide for yourself. And if you go further out, it doesn't look nearly as attractive as like that is a whopping difference for 200% APR versus 85. And then one more to look at here, we've got NVIDIA. NVIDIA is a very popular, highly liquid stock. So basically anytime that a option value hits, you're going to fill. Hopefully that snapping didn't mess up the sound. And you can look out here pretty far at the 321, and we've got a really nice looking return there. Nice. And with a 50% buyback, let's change this to, what would 50% be? A 15, we're going to say 7 days. That could be a good position because of how volatile NVIDIA has been recently as well to potentially go in. I don't know. I wouldn't mind owning NVIDIA at 125. Certainly, I could just buy it right now for 125. But I personally might think that, okay, it's going to go up. So if it's going to go up and I sell the option on it, well, I can buy it back for 50% and make a really nice return on my investment. Now, in order for NVIDIA to get to a 50% buyback rate, what do we have to get to? Realistically, again, this is based on the Vega. I'd have to look up the specific Vega for NVIDIA. But, just on history, it probably has to hit $130, something like that, right? And the price of that option would drop to, instead of paying $650 for it, I could sell it at $325. Again, you need to look that up and find out what the individual change would be for any given stock. And all of these numbers, from the time that you look at them, can change. Keep that in mind. As catalysts occur, as the market changes happen, as the administration makes, some crazy change, or worried about some big event like World War III, or maybe less apocalyptic. Maybe there's some huge change to like universal basic income. I don't know. Whatever giant change that you can imagine in the economy could also impact this after you sell it. So you got to keep that in mind as well. Markets can go up as a whole or down, and that can impact you. And if you're selling a cash secured put and things drop, just remember that that is the risk that you're taking in selling these options. It's not free money. Now, it can feel like free money when you win, but there is risk. Otherwise, everybody would do it all the time. So there are going to be times where you get assigned. There are going to be times where the underlying goes down or up against you in the way that you're not expecting it to or not wanting it to. That could be if it goes up and you're trying to sell covered calls, well, you could get assigned and miss out on a ton of upside. That happened to me with HIMS. I sold covered calls at 29 and the stock went to 50 and I had to sell them at 29. I mean, it was still profit, but at the end of the day, that's the risk you take in doing this especially on individual stocks. Now, again, you can do this on SPY. You're going to see the changes in SPY are wildly different compared to what we've got for like Hood as an example. A share price of $594, you're going to need at least $59,000 and 59.5. It looks like that just updated. I guess the bell has started for the day. And the option cost is likely going to be way lower if you want a strike of, say, 600. And I don't know. I'd have to look this up. I guess I could look it up real quick. Give me a second here. We're going to go to, I'm going to use Fidelity, and this will be live. And I'm not going to show you because I don't want my account information plastered all over the internet. So you're just going to have to believe me here for a second as I bring it up. But they have an option chain screen that you can go to, right? And when you look at it, you're going to find that you can look up as many weeks as you want. Typically, you can there's a whole bunch of different options on how to view it. So if I go to the option screen, bear with me just a moment. And yeah, so right now the price is $596. This the Google Sheets doesn't update instantaneously, but if I were to look at the price for, and I could put in a custom range. So we're just going to do $5.99 to $600, so I can put a bunch on the screen at once. And let's say I wanted to sell puts. Like, well, you know what we could do? We could do that too, actually. You can sell puts for above the price that it's at, which is kind of interesting. And if I wanted to sell puts for 600 strike, if expiring this week would be, oh, I'm sorry, I forgot, they've got dailies. So I've got to, I've got to make sure I'm not looking at the dailies here. So the 7th would be 633. 683 to sell it at $600. You can see the APR is way different than like Clove, as an example. Now, this is out of the money. This isn't really a great example. Maybe we should look at $5.95 because that would be out of the money and more realistic to what you would sell something at. So you can sell things that are currently in the money, right? You're basically betting that the price is going to go above that, which it could. Or if you were to look at March 7th and say, well, I think it's going to be $5.95, the price is $4.39. You can see that APR all of a sudden starts shrinking a little bit because SPY is not as volatile as Clove or any individual equity typically, because it's an aggregate, right? It's an index of all of the different S&P companies, which wouldn't even include companies like Clove to begin with, because you're talking about the top 500 in the world. So none of those, I mean, any individual one could move 10%, but when you've got the entire market that's averaged out, often SPY moving 1% is a big deal, right? That's a big percent move for them. So you can see very quickly the calculation changes. And if I wanted to click some of these off and start looking at, you know, week ending the 14th as an example, the price goes up to 631. And if I wanted to look at the 21st, it goes up to 815. Oops, I almost missed it. And then we're just going to clear these out for now and not look at them at all. So you can see you have the same effect, right? You have the annual percentage dropping if you hold these to expiration. But again, if you were to buy them back in a shorter time period at 50% or better, you start seeing a pretty even return from next week's option expiring or buying back 50% for the week following. So it all comes down to, how do you want to deploy your money? What is your strategy in it? And that is a topic for another video. We've already gone way too long here. But again, if you liked it, please consider hitting the subscribe and like button. It does help. Helps other people see this, helps me. And then certainly if you've got questions or comments, let me know. And feel free to look in the links below in the About section for a link to the spreadsheet and a couple other things. I'll also link After Hour if you want to check that out. It's a fun site that I like to share a lot of the stuff that I'm doing in text form. I don't care if you join it or not. I don't get paid for it, but I think it's a great site or a great app and worth checking out. So yeah, hopefully you enjoyed that video. We'll see you in the next one where we talk a variety of other topics. What it'll be? Well, there's only one way to find out, and that's to subscribe. See you in the next video. Bye.